here, you know, if you're having any technical difficulties logging in virtually, there's some information here that will help you out and be able to log in. The next couple slides, the next two slides talk about CPE. The first just gives prerequisites, communicating information that we're required to communicate, so you all can receive CPEs today. And then the next one is just a couple of housekeeping items. To receive the CPE, you guys all have a survey, either hard copy for those in person today, or there will be an email survey for those of you participating online. You do need to complete the survey and submit it back to us so that you can get your CPE credit and the certificate. And additionally, throughout the webinar and the seminar, we'll say like 3 random words, so that you need to jot those down and submit them with the evaluation so that you know you're here and listening. We work with over 500 nonprofit organizations here in the Maryland, D.C., Virginia area, as well as nationally and internationally. So with that, I'll just turn it over to Dick to introduce himself and give a little background on the nonprofit tax work that we do.
Good morning. Hope you're all excited to be here. I've had my coffee. I'm good. I was up early. All excited about talking about 990s. That's not it. Although it's probably one of the funniest things I'll say today is actually not a joke. I spent a lot of time I'll give you a little bit about my background. I started out my career working for a couple of, what we used to call Big 8, Big 6, now I call Final 4 accounting firms, right? If you go down to 3, we're all in trouble. Nobody will be able to switch firms anymore, right? So I spent my career after starting out in a smaller office, doing a little bit of everything. I focused to be a big IRS practice. So I got my start in dealing with nonprofits in IRS, which is a great place to start because they have all the issues that you all will run into. It's also how I met my wife, which she worked in college, and she was one of my clients. And she was working up in the code union, and now she's at Georgetown. And really, the reason I like it is I like to help nonprofits be able to just focus on their mission. And our job really is to advise you to protect our clients and advise them of issues that may come up. And really, the 990s, if this election cycle has taught us nothing, and hopefully it's taught us more than one thing, is 990s are important, right? When's the last time that on a debate or on a news, they were talking about the 990s of the candidates, of organizations that candidates were related? Right, we got this 990 BF for Trump Foundation and the Clinton Foundation 990. So these are important documents. We'll get into more detail why. But with Gelman, I head up our nonprofit tax department. We've got 9 professionals, and we spend our entire days advising and doing 990s for nonprofits. We have about 500 clients, and as I said, I actually really enjoy talking about 990. So Jen's main job today is to keep me focused on what the question is so I don't talk too long. And with that, I'll turn it back over to Jen.
Great. And so actually I'm on the audit side. So my specialty and expertise is on the audit of nonprofit organizations. with a concentration of those that receive the federal funding, so the single audit in accordance with what's now uniform guidance, what used to be A133. So when we thought that let's do a session, a webinar, a CPE on 990 issues, we get questions all the time about them. I was like, ooh, yeah, I can do this, but I'm going to need to bring the experts. So septic into coming up here to Baltimore this morning to present to you all today. So we're going to dive right in. We're going to start with just some very basic things, and for all of us in this room and those listening, we all probably are at the point where we file a 990. So there's very little to say about who doesn't need to file, but there are certain thresholds. Some organizations that receive very minimal receipts can file a 990N, which is just a notification to the IRS telling them, yes, I received less than this threshold, and that's it. And there's nothing else that they need to do. There's also, just like in our personal tax return situation, there is a 990EZ, again, driven by a threshold of revenue and receipts and assets. So if you receive below a certain threshold and have a certain less than a certain threshold of assets, you can file a short condensed form of the 990, which is referred to as the 990EZ. And I believe churches and religious organizations also are not required to file a 990.
There's some categories of organizations that are not required to file 990, and churches is probably the biggest one, although if they have unrelated business income, they would have to file a 990P. Although it's really difficult to audit a church because of the guidelines that are in the code. So you don't see a lot of activity in churches getting audited on that. But one of the main reasons is they're typically not required. In organizations that have a close connection to churches, also may not have to file a 990.
So for the purpose of any tax return, obviously, first and foremost, it's reporting your activities back to the IRS. But for 990, it's something special because we have that exemption from taxation on our activities. It's really a way for the IRS to make sure that we're still operating our activities within compliance of that exemption, that we're not, violating that in any way and avoiding the taxes that a for-profit organization would have to pay. And recently, it's now become, well, not recently, but more importantly, and as Dick had mentioned, the public scrutiny of this document is just heightened year over year. We see that in the news and the elections and on the front page of the Washington Post when something comes up in the 990 that's controversial. So it presents a certain accountability for an organization because this document is such a public document and it's being used as a tool for the organization to present itself to donors and the public.
Just a few comments on that. Every organization is different. C3s are accountable to, obviously, the public. Donors are typically one of their constituencies. But there's a lot of constituencies related to, I always ask organizations, who's the reader of your 990? If you're a membership type organization, maybe it's your members. If you get a lot of funding from private foundations, maybe it's those folks in private foundations want to see what you're representing to the public that you all do. State attorneys general are a constituency. They want to make sure that, one of the things that we talked a little bit about, I mentioned a little bit before about the Clinton Foundation and the Trump Foundation. Well, as a result of some of the scrutiny, the AG in New York said, wait a minute, stop soliciting funds. You're not registered here. Specifically, if you're doing business in the state AG will say, you need to register to do business here. And if you're not, then you can't, the mechanism they have to stop you is they say it's illegal or you must stop soliciting funds until you get your registration up to date. So there's lots of different constituencies that come into play here. And we typically present the 990 to the board if our clients want us to. And it's important that the board members as well understand what the organization is putting out there at 990 to tell the public this is who we are, this is what we do. Charity Navigator, GuideStar, other ratings agencies, Better Business Bureau. That's where do you think they get a lot of their information to great organizations? It's from the 990. And I know that Charity Navigator talked about going to the next step. What is it? Charity Navigator 3.0. I think they may be going to. And part of it, what they're doing is saying, when you're raising money and telling people this is what you're going to do with it, are you actually doing that? And the mechanism, one of the prime mechanisms is the 990. We'll talk about Section 3, or Part 3, that gives your, this is all the good stuff we do. Does that match up with what we're telling prospective companies? So there's lots of readers of the 990. I think every organization needs to be sensitive to who's my constituency, other than maybe the regulators or Charity Navigator or GuideStar. Who am I trying to tell my story to? Who am I trying to answer questions before they write a story about it in the paper and get it all wrong, if that happens too.
Absolutely. Just a couple last items. The filing deadline is the 15th day of the 5th month after your fiscal year. So December 31st year ends. The first deadline is May 15th. You're allowed up to 2 extensions, and so the latest a 1231 could file would be November 15th, which, bless your heart, you're here today with your November 15th deadline, and I'm sure a big case full of 990s to get off your desk. So the basic form, so we've given you all the basic forms within your packet, as well as some supplemental schedules that we'll be going through. So we thought it was really helpful to have that, so as we're walking through, you can follow along. You'll see that the basic form is 12 pages, 12 parts, but as we will go through, there are many supplemental schedules, there could be additional information that is required in Schedule O, so it would be very unlikely that 12 pages would be all an organization would file and submit. Megan, did you have questions? Yeah.
Yes, and that'll happen. I believe it's effective next year. And I have mixed feelings on this. I'm on the.
So let's repeat what Megan said.
Oh, yes.
Yeah, so we can hear. Go ahead.
On the comment, currently there are 2 3-month extensions, right? So we file an extension for some of our clients in May if they're a calendar year, and then we bug them before August, and then we bug them before November, right? So that is changing to a 1 6-month extension, which I'm on the AICPA tax resource panel for exempt organizations, and I actually was involved in writing the letter that we wrote on behalf of our committee to go to a 6-month extension. And I did it with some apprehension, because now I think we get a lot of stuff in the summertime for a calendar year, but keep us busy in summertime and get things done. And now I'm afraid that people will just all wait till November or till May 15th if you're a junior end. So, but it was the right thing to do, I think, for the industry and for the lack of paper. Having to file these things, and sometimes people that do their own, they may forget about the second extension or miss it. So I think it's a good thing overall. It's just as a practitioner, it makes me a little apprehensive that my November deadline will be bigger than it needs to be. So.
Great. So let's dive right in. We're going to touch on parts 1, 2, and 3. So part 1, just your general information about the organization, your reporting period, the name, address, website. I think one of the things just to mention here is that you'll want to make sure that you're reporting the most up-to-date information. Sometimes you move locations subsequent to when you first prepare the 990, so just ensuring accurate and up-to-date data. The next item is just a summary of financial data. And so we're not going to spend too much time on that because we'll really get into the financial data and some of the other parts as well as the supplemental Schedule D. But the third part, part 3 of the 990, is the organization's mission and significant activities. And this is really the first hot topic of a 990, and where Dick and his team really, push our clients to focus on giving more information about what they did this year. Brag about your activities, what the organization did that is good that you can put out there. So I'll let you speak a little bit on that because it is one of a key importance within the Form 990.
Yeah, and a little bit on the summary of financial data. This is what the IRS thinks is important, and so you can get an idea about how many independent board members do we have, how many volunteers do we have. It was designed to be a snapshot of the organization. As Jen said, we won't spend much time on it because it pulls information from elsewhere in the 990, but it does give you an idea of the things that the IRS may think are important. And we'll talk a little bit more, but the IRS is going to what they call a data-driven analysis on selecting organizations for audit and for compliance. And while this will give you some idea what they think is important, but it's really all the information on the 990. So that's the data-driven. Is Jen mentioned, this is really the opportunity to tell the world and tell your constituency all the good stuff that you do. And you break it down just, your 3 major programs by expense, and then you also give the revenue that program generated, not contributions that were allocated to that, but other revenue. If you have, let's say you have a theater and you do performances and you generate ticket sales, that would be revenue generated from that particular activity. And then, of course, any grants. You break out in your expenses is going to be a grant number, and they want that by program. So this does a lot of things. It's always a balance. I have some clients that just say, we're a school, we educated 233 people. That doesn't really capture all the great stuff that the organization does. And there are some organizations that will go on forever and explaining it, and that's great, except that I think you get a little reader fatigue, I'll call it, where they go, oh my God, how about bullet points? And you can put a link to a website that says, here's where you can find out more about it. There's a lot of ways to create that balance, and that's what we try and bring to our clients. But it really, as I mentioned with Charity Navigator, we talked about, is this the best way we can tell our constituents capture all the great things we're doing? And I think, we push our clients to update them every year. Oh, we had an annual conference. Well, how many people attended? How many topics did you present to your constituency, to your members, to the attendees? Those are all good things to add to, in that example, to your program descriptions. And, don't be afraid to, this tends to be focused on the finance folks, right? But reach out into your organization, particularly if you're a bigger organization, and say, who's really good at writing? Well, maybe it's the people in the marketing PR that do your newsletters and do that kind of thing. Maybe they can put a nice, concise package together about all the great things that you all did.
And, this is one of the parts that we take what you're giving us. Like, a lot of the other information we have expertise in, so we take it at face value. So we really, like as Dick said, encourage you to spend some time on it to really present your organization in the best way.
One of the other things that we often overlook is it asks about activities that you ceased doing or new ones that you started. And it used to be when you said, the IRS would say, did you make changes to your organizational documents, which is also a question not in this part, but used to be connected to this. Or, did you start some new activities? The IRS used to send you a note back when you said, yeah, we changed our bylaws, and then they'd say, oh, you're still exempt. It's still good through the information, which nobody ever really paid attention to, and it was a lot of paperwork. And that was a long time ago, but this is one of the ways that the IRS, sometimes I look at a new organization, and I look at their 1023 protection, and then I see what they're doing under what they say in 990, and go, this doesn't quite match up. And you want to be careful to answer that question when you do have new programs and things, so that your defense is to the IRS, we told you we were doing these things, and this was your opportunity to, if you had questions about it or challenges, that was your opportunity to do so. But we're being upfront that, you know, we added this program, or we went maybe in a little bit different direction, but still an exempt purpose. This is those questions are designed to highlight that for the IRS, and they're really resource constrained, so they have. It's not like they've come out and audit you on that, but it is good to be upfront with your constituents and the IRS to say these are the new things we're doing. This is what we've stopped doing.
So the next slide discusses parts 4 and 5. So part 4 is a checklist of required schedules. It crosses a couple pages, but it's basically, you'll see 38 yes or no questions. And so what's important here is Dick will go over some of the specific questions that are really key, but every time you check a yes in one of those 38 questions, it's going to generate a supplemental schedule. It's going to ask for more information. Did you want to touch on any of the specific questions?
Well, yeah, and before I, feel free to ask questions as we go through on things that are important to your organization or things that you may have struggled with. Overall, I had a question up front about, you know, has there been any changes? And the answer is there's typically changes to the instructions, but, and I will keep saying this, the IRS is very resource constrained. Their budget is getting cut, which is kind of interesting because they actually, the more money they have, the more money they're able to bring in. So I don't understand the economics behind cutting their budget so that they can bring in less money, so that we can then cut their budget. Whether it's, you know, and that's not a political statement, it's just, if I give you $1 and you're able to collect more money with that, why wouldn't I give you $2? You know, I don't know. But they, particularly in the exempt side, they're very resource constrained. So there are often changes to the instruction. And I mentioned the AICPA-TRP. One of the things we do is provide the IRS every year with suggestions on changes to the 990. And typically, if it's a change to the form, we don't even bring it up because they'll tell us we don't have the money to change a form. It takes a lot of money to redo that. But they change the instructions, and they add things to the instructions, or they tweak the instructions to maybe make it consistent with a law change or with some guidance that the IRS has put out. The problem is the questions themselves don't change. So there are instances where the question will say, check the box if this, and the answer is, they'll tell you in the instructions, don't check the box, even though there is some inconsistency. And just, are there, before I get into it and highlight anything here, are there any questions or comments that you all have on that?
Yeah. That's interesting. So the question is, you know, if we're starting a new program, when do we set up a new bank account if we need to, and do we set up a new EIN? And so the EIN would really be if we were setting up a new entity to segregate the activities for some purpose from our existing entity. And you know, in an instance where maybe you are a nonprofit organization and you know that you're going to conduct for-profit activities under this new program, that might be the best decision that the board can make, is to house those activities under a for-profit entity that would ultimately be consolidated if governance is the same across the two entities. So that's more of a look at, you know, what kind of activities you're starting to go down. I would say that if it's existing activities to support the mission of the organization, and might not have different tax implications than your existing entity, then setting up a separate subsidiary or whatever the case may be, might not be efficient as far as tracking finances or the time and effort that it takes to do so. So certainly something that you would want to bring to governance and management of the organization. And as far as the bank accounts, you could set up a different bank account to segregate those funds. If there's something that a funder requires you to segregate their funds, that you have to do that. But otherwise, you can track those activities separately within your general ledger by different cost centers or something like that. And so, while not physically segregated, it can be tracked separately. You're very welcome.
Any other comments or questions? That's an excellent question.
So Megan's question was, can we describe what a disregarded entity is?
And yes. Not that there's a six. I hope so. And I was at there's some law firms that do tax exempt work as well, and we work with them sometimes to give them ideas on things we see. And I was at Kaplan and Drysdale this thing on mergers and acquisitions in the nonprofit space, which was really interesting. And I was giving some 990 perspective on that. It was a good back and forth because they say, don't forget these questions. We got a lot to disregarded entity. And a disregarded entity is a single member LLC, limited liability corporation. So it used to be people did things through other business entities. Limited liability corporation can be a number of things. If there is one member, it's a disregarded entity. For state law purposes, it's a separate entity that protects the organization, the members, from liability. But for tax purposes, it's disregarded, which means all the activity is treated as though we conducted it ourselves if we were the single member LLC owner. If there's more than two owners, it's taxed as a partnership typically. But can elect to be treated as a corporation. So there's a lot of flexibility. That's why it's used so much in planning, is that there's a lot of different ways that it can be used and be for tax purposes. So it's got the advantage of the protection of a corporation with either being treated as a sole proprietorship, disregarded entity, or as a partnership. So we see a lot of that when you're conducting an activity that is an exempt activity that you want to keep within your corporate, your exempt purpose, but where it may present other liability issues and you want to protect the assets of the larger organization. Sometimes renting real estate is typically. There's also title holding companies that used to be used for that, but now they're a little bit obsolete because you can do it through an LLC. But in talking about these 38, yeah, follow up.
No, you could still account. So the question is that on the accounting side, if you have a single member LLC, do you have to have a separate set of records? I would say you would definitely want a separate sort of account that's specific for that LLC, and so that the activities of that separate entity could be segregated if you just wanted to pull that. But ultimately, if it's being consolidated under the larger organization, you can accomplish that through a cost center or a subcode or something. So I've seen it both ways, and I think just the importance there would be to be able to completely segregate the activities of one entity versus another.
And one of the things to be careful there, and I'm not giving legal advice because we're being, I do have my JD, but I practice with a public accounting firm, so I don't want any lawyers to go back saying you're practicing law illegally. But from the corporate, because it gives you that liability protection, that you have to respect that entity you have to respect the corporate entity. And so the lawyer should tell you, okay, you need to have board meetings, you need to do these certain things to respect that entity, regardless of how you account for it. There are certain things you need to do to respect that. Otherwise, you could lose that protection, and they would attribute the activities of the LLC or any subsidiary up to the parent.
Yeah, no, that's a great point. Even if it's a disregarded entity, or that, you know, it has very limited activities like annual board meetings with documented minutes, there's a whole separate like governance policies and procedures that would need to be followed to ensure that there's no blurred lines, basically.
Just to run through a couple of questions here that you know, we typically see answered. You know, question one, you know, are we a 501c3? If you can't answer that, you probably should be doing the hot thing, right? Or flip to the first page and see which box you check. Now that's for, and we'll talk about Schedule A a little bit, the public support test. And if the answer is, can I succinctly describe the public support test, the answer is no. Okay, I'll just tell you. Not that I won't try, but I'm just going to tell you up front. And then Schedule B, if you have to attach a list of contributors, those two are typically, for a lot of organizations, are checked yes. Then we get down into questions that, in the middle, starting with, you'll notice it'll tell you which extra schedule or which part of a schedule you need to complete if you answered yes to that question. So you get into the question starting with 6 and going down all the way to 12 about Schedule D, which is just additional financial information, and we'll look at that. Question 17, if we had fundraising, professional fundraising services over $15,000, or did we have a fundraising event that would be reported on Schedule G? So those are just some typical things on that page. And then you get into if we had grants to either individuals or organizations, domestic or foreign. That's you look at question 21 and to 22, and then question 23. That's linked to Part 7. And did we pay anybody more than $150,000 of reportable comp, or did we answer certain questions? Then we would have to fill out a Schedule J. Schedule J will look at more detailed information on comp. For some organizations, that gets a lot of scrutiny. And then really getting down to questions 33 to 36, which are questions about related entities, including disregarded entities. If you have a subsidiary disregarded entity, you would have to fill out Schedule R and disclose certain information. The thing to note about that, if you have those, there's certain thresholds, dollar thresholds for reporting transactions, for certain relationships that would require us to report transactions. You want to be very careful. That was actually one of the things I think that happened with the Clinton Foundation. And the reason I know this is not because I work with them, although I do know somebody that actually did work on that. But they at the ASCPA conferences that summer, they dissected a 990 of the Clinton Foundation. I think they used the Clinton Foundation. There were lots of relationships they had with foreign entities that I think they amended and disclosed those. And sometimes it's not always clear what your relationship is. So if you're a large multinational operations, you know, you have to look at those and be careful. But that was one of the things that I think they amended and disclosed in more detail. Question, comment? That's an excellent question. When we get to Schedule A, remind me, and we'll talk about that in some detail on Schedule A and Schedule B and how they relate, and a little bit about the public support test. As I said, Jen will cut me off if I speak too much on that. But that's a great question because you need to know, are we disclosing the appropriate level of donors, or are we over-disclosing, and those kind of things. I think that's important.
So we'll have links to that one. And then the Section 5 is are some various questions on other IRS filings and tax compliance. So here we see things come up like foreign accounts, or if there was UBIT, unrelated business income tax, you mark yes, and then you go and fill out your 990T that we'll talk about in a little bit. It gives a little bit of information on the salary withholding, what we issued as W-2s versus 1099s. Anything else?
Just a couple of thoughts on that. And this is where I think some of the instructions have changed. When they talk about 1096s, that's the transmittal form that goes with your 1099s, and then your W-3 is obviously your transmittal for your W-2s. And one of the reasons they ask those questions is if you're of a certain size, you need to electronically file your return, and if you don't, they will bounce it back and say you better file it, or you could be subject to. They treat that paper filing as though it didn't happen because you were required to electronically file. And one of the thresholds is 250 or more forms, and it includes W-2s and 1099s and some other things. So we want to. So that's one of the reasons that's there. I love this question. Did you have unrelated business income of more than $1,000? Yes. If so, did you file a 990T? That's like at the airport when they used to ask you if you packed your own bag. Did they ever catch anybody on that? But I commend them for trying. The other thing is foreign accounts. What used to be the PDF 90-22.1 is now the FIN 10-114. That, just so you know, next year, I believe it's beginning the filing deadline, it used to be June 30th for everything. It's going to move, and I forget exactly when it's effective, but it's going to, I think it's April of next year. It's going to change to April, and you can get an extension, which again, I'm a little conflicted about because I think it's just, they're pretty easy to fill out, but I think it'll just be, people will miss next year and file them late, but the IRS has been pretty good about not imposing penalties on that.
Great. All right, so we're going to go to the next slide. Before we start, we'll give our first CPE word, which is October. Yes, it is October. The next couple parts, pretty important parts. Part 6 is our governance, management, and disclosure. So this is really what the IRS considers as best practices for an organization when it comes to governance, its policies, and items like that. So in Section B, you'll see various questions such as, did we have a whistleblower policy, a document instruction policy, and so really in this section they want to see yes. It is their way of saying you should have these things in place. So we always like to just kind of go through your own 990 and see where you are, and if you are answering no to any of them, maybe consider implementing some of these policies that they have here.
A couple things. The first one is government management, and when we talk about a data-driven approach by the IRS, and they were talking about this when the form first changed in 2008. How many voting members and how many independent members? Well, lots of organizations, if the executive director or president of the organization is also a board member by virtue of that position, they would not be independent because they received more than a certain amount of compensation from the organization. That's not a bad thing. But if you have 3 board members and none of them are independent, because they're all receiving them, the IRS will say maybe that's somebody we should look at. Also, significant, I'm speaking at a DC bar thing beginning of next month with Steve Clark, who was instrumental in designing this form, and somebody asked me, can you talk about significant diversion of assets? That means somebody embezzled from you, and yes, that's a requirement that you disclose that, and there's also questions about how much you disclose because the person's made, and it turns out they weren't guilty. You've got libel issues because it's a public libel or slander because it's a public document. So there's some questions about that they think more independent is better than less. And then we get down to the policies. I love the policies. It requests information about stuff that's not required.
Yeah.
Whistleblower is not required. Conflict of interest is not required by the IRS. You have state law requirements that you always have to follow, and they may have policies and procedures that are required. but it is, as Jen said, best practices. And one of the things about the 990 and how you review it, most of our organizations will send it to the board. It doesn't mean the board has to necessarily review it, but in order to check that, yes, it has to go to the entire board, and it has to be the filing copy. I have clients that redact the donors' names. Well, technically, the board did not get a copy of that, what was filed with the IRS. Some people will say it's going to be reviewed by the audit committee, and that's enough. You can't check that yet, but it's important that you explain what your review process is, that, you know, goes to the audit committee, they review it, they do all this stuff, and, you know, they recommend to the board that the board, you know, approve it, but the board doesn't actually get a copy of it. You know, there's lots of different ways to explain that, but in order to check it, yes, before it's filed, they have to receive a copy of it. They don't have to review it, they don't, you know, but that's one that we, most of our clients will check yes on. And again, these aren't required, but the IRS thinks it's good practice, and quite honestly, it is good business practice in a lot of regards.
The next schedule. So, Part 7 is on compensation of officers, directors, key employees, highly compensated employees, and contractors. So they want everything in the kitchen sink about compensation. So I'm just going to go through a couple of the data points that they're asking for. They are asking for the name and title of these key employees, their position within the organization, and there's 3 different sections on what they want information regarding compensation. The first being W-2 and 1099 reportable wages, and there we're talking about both salary and bonuses, pretty much anything that is going to factor in on your W-2, as well as reportable compensation from outside sources, other sources. So really interesting. They really want a lot of information on this section, and I'll turn it over to Vic to talk about.
Well, particularly if you have a related if you receive compensation from a related organization, if you have relationships like that, so you'll see the concept with this when the form change was reportable compensation. They want a baseline that everybody was starting with, so they could better compare apples to apples. And for the most part, it works pretty well. A couple things to remember: it's calendar year, so it's the W-2 for the calendar year that falls within your fiscal year. Or if you're a calendar year, then obviously it's easy. And reportable comp is box 1 or box 5 of the W-2, whichever is higher. And then, so that's the concept of reportable compensation, which is used to measure, you know, if you have to, you know, from that organization and from other organizations, related organizations, for services. Because what the IRS used to worry about is, oh, well, we want to pay our president $500,000, but that would look bad. So we'll only pay him $300,000 or her $300,000 from this organization, and we'll set up a subsidiary and they'll pay him $200,000. So that got rid of that concept. You know, the IRS was you know, pretty cognizant of some of the things that organizations would do, so that they didn't have to report this. Because remember, for some organizations, this gets a lot of scrutiny. Anybody give me an example? Yes, ma'am. Now you got to give an example. All right, we'll ask your question and then we'll come back to that.
So the question is if the president's on another board of another organization that's unrelated to our entity or kind of related. So, a partner organization, but they don't receive compensation. So you would just report 0.
You would report them as an officer on this and their compensation, and then on the other organization, if they're technically not related, you would simply report them as a board member, and you know their hours a week, maybe it's an hour a week or half an hour a week they have, and then 0 compensation. And if they're not related, then you don't have to report that. If they were related, and this happens as well, you would report that as so let's say there's overlapping boards, and you're president of one, and by virtue of that, they sit on the other board, or because of the connection, they sit on the other board. You would report estimated amount in column F or I'm sorry, column E, reportable comp from a related organization. So you would show 0 in column D, reportable comp from the filing organization, and you would report his or her comp in column E, saying they get paid. And sometimes we recommend a Schedule O disclosure. It says, by the way, so-and-so sits on the board of the related organization, receives no comp from us. Their compensation reported is as an officer for their duties at ABC organization. So what are some organizations that have a lot of, that may get a lot of scrutiny on their compensation? Yeah, there are some organizations that pay a lot. Just by way of industry, C6s tend to pay more than C3s because they're drawing from their industry. And the IRS says when you go to comparable wages, you can look at what for-profits or other nonprofits would pay for that same, you use comparables. And if you're the head of an aerospace company and there's a trade association in aerospace, well, in order to get him or her to come to your organization, you're going to have to pay them similar to what you would pay them out there in industry. So C6s tend to pay more than C3s. Anybody watch college sports? Yeah. I believe Nick Saban is the highest paid state employee in the state of Alabama, right? Coaches. My wife works at Georgetown. And so we were watching the NCAA tournament when John Thompson III first came there, and they had a good run into the NCAA tournament. And he was a new coach, and somebody said, boy, they're going to have to pay him a lot more money to keep him at Georgetown. One of the commentators, and my wife went, great, because she's head of comm at Georgetown. So yeah, so we talk about these things all the time at home. We have really exciting stuff. But we do talk about how what the perception is out there. Colleges and universities are huge. They tend to be June 30 year end. By May 15th, which is our final filing deadline, I'm sure there's a Washington Post reporter or somebody on their doorstep saying, give me your 990. I want to know what John Thompson made. I want to know what Jack Joy made. He's the president. And it's for organizations, colleges and universities all over the country, particularly those with high-profile sports programs, because the coaches tend to make millions and the professors tend to make a lot less. That annoys a lot of people, particularly the professors, and maybe rightfully so.
So the question is severance of an executive officer reportable compensation in Section 7?
And the answer is yes, and then the question gets how much and when do we report it? So if it's taxable compensation, you have to be careful with severance pay plans, and I'm not a benefits expert, but there are some severance pay plans that say we'll pay you when you leave, and you're entitled to that today. You have to worry about Section 409A, and you have to worry about Section 457 that governs the timing of that tax. If it's in the W-2, it's reported in column D. Okay, now we'll get to Schedule J in a second because it may be broken out separately in Schedule J. If it's not taxable, but it's a benefit that's accrued, you may have to report that instead of D in column F, estimated amount of other compensation from the organization, even though it's not taxable today. So let's take for those of you familiar with 457 plan, I could say to the executive, okay, I want you to stay for 5 years. And if you stay for 5 years, at the end of that 5 years, you'll get $500,000. But if you leave in year 4, you get 0. So it's, and again, I'm not a benefits expert, but it's subject to a substantial risk of forfeiture. You have to perform future services in order to get that. Okay, that's taxable in year 5 when you're entitled to it, even if you don't receive it yet in year 5. So you've got to worry about that timing. The way it works in the 990, and before they changed the form, there was lots of different ways people treated it. You're supposed to accrue, let's say it's $100,000 a year of benefit, you would have to report as other compensation $100,000 of that benefit, even though it's not taxable, and they may actually never receive it if they leave before the end of 4 years, or 5 years rather, in my example. Now, this would be a good time to flip ahead to Schedule J. Yeah. So severance pay plans, be careful about the timing of that. If you look at Schedule J, which is probably one of the last things you have in your package, to give a little, since it's relevant to the question and to what we were talking about, the first page is, here's some questions about your compensation practices. Question 1A, for those of you that are from in the D.C. area, the greater D.C. Baltimore area, you may realize that first class or charter travel, travel for companion, tax gross-ups, discretionary spending account, housing allowances, business use of a personal residence, health or social club dues, personal services, maid, chauffeur, gardener, and all that kind of stuff. Those questions could have come right out of an article about a university president in the general area. Could have checked all those boxes. So the IRS is saying, what other things do you provide? And they want to know, is it included in the compensation? Also, question 3 is important. How do you go about setting compensation? You know, what safeguards do you use? Anybody familiar with the rebuttable presumption of reasonableness? The IRS will say, if you do these things, if you do certain things, like have an independent comp committee that uses comparables, and they document it properly and those kind of things, when the IRS comes in to look at the compensation, they will say, if you satisfy the rebuttable presumption of reasonableness, the IRS has to prove that it's unreasonable versus you having to prove that it's reasonable. It may sound like a slight thing, but the shifting of the burden of proof in an exam situation is extremely important. So those are the questions there. And then, did you have a severance pay or change of control payment? Did you have a non-qualified deferred comp arrangement? They want to know about all those things. And then, importantly, it takes the comp for anybody that received more than 150 of reportable comp, and it says, okay, take column D, the reportable comp, and break it out between base, bonus, and other. And then take all the other comp and break it out between retirement, non-taxable benefits, and total. So it makes you really go through and detail out what compensation that those people that qualify from Part 7 have a sufficient amount of reportable comp from the organization and from related organizations have to report it. And notice there's 2 lines, 1 and 2. 1 is from your organization, the top line, and 2 is from related organizations. And sometimes people will receive things from both. Yes, sir. And one of the key thing to start when you're looking at those things is they go through a detailed instruction here. But basically, some things about officers, directors, trustees, those are typically by title. And some organizations are smaller and they say, well, maybe I don't have any officers. But the top management and the top financial people, even if not by corporate documents, are considered, for 990 purposes, officers of the organization. So you may have somebody who's a controller that says, well, controller is not defined as an officer of our organization. The IRS says, top financial person, they have to be listed. The executive director is going to be an officer, just based on the duties rather than what the corporate documents entitle. Then you.
So we're just talking a little bit, the question was, you know, what's the actual definition of the key employees and officers and directors of an organization, because ultimately, you know, you may want to minimize the information you're putting out there. So we're just starting down that path.
Yes, key employee is important because one of the criteria, you have to have certain duties that rise to the level of key employee, and that can be subjective. But one of the thresholds is you have to have 150,000 of reportable comp, or you're not a key employee, no matter how key you may be to the organization. You would be a highly comp, but not a key employee. And that's meant to cap the number of key employees you have, and I think it's capped at your top 20, because you look at a university or a hospital or a large organization, they can have a lot of people making that kind of money that have discrete duties that would rise to the level of being a key employee, so they cap that. I believe it's your top 20. And then your highly comp, somebody that has 100,000 or more of reportable comp. Are there particular situations that yes. But it's only your top 5. No, and that's a good question. Just to frame this, we're talking about how do we go about and decide. We've got our officers, directors, trustees. By title, any compensation they receive is reportable. And then key employees, if you let's say you had nobody that was making more than 150,000 of reportable comp, you wouldn't have them. You would have no key employees. And for mid to smaller organizations, it's not unusual for them to have no key employees. Then you get to 5 highest comp. That's the next 5. So you have your officers, directors, trustees, any key employees, and then your top 5 highly comp. And then you end it at that. And the IRS will ask a question at the bottom of Section A of Part 7, how many people made more than 100,000? You would disclose just the number. But you would only have to disclose that. So if you made the decision that, look, we've got a lot of people who are important that make more than 150,000, but they don't have the requisite duties or oversight, so we have no key employees, then you're just going to be disclosing your top 5. In practice, a lot of organizations, that's where they end up. $100,000. Correct. And if you had 50 people making more than 100,000, you would only disclose the top 5. So, and that's the process. You go through and determine officers, directors. You have to report them in any comp they receive, even for services not related to, let's say you had a board member that also did some consulting. You would have to report that, even though it wasn't related to their board duties. Because I've had some conversations with folks on that. And again, with smaller organizations, they have board members that have an expertise in their mission. So they may provide services, and that's appropriate. It just may need to be disclosed. Yes, ma'am. Correct. So let's say in the example we had before, we had no key employees, but 50 people making more than 100,000 more of reportable comp. You would report the top 5, and then just you'd say we had 100 people. But we wouldn't have to disclose the names. We would be limited to the top 5. No, it's going to be controlled by the IRS. I think really relies on corporate documents as soon as an officer of the organization, and then regardless of title or the top management and the top financial person are always going to be considered to be officers for reporting purposes, and that creates a lot of confusion. We have lots of organizations that probably report more officers than they need to. Some of it may be a PR thing, It's like when the government says all non-essential personnel, can stay home today. Everybody's like, well, that's me, right? I'm non-essential. But then it comes time for your review with HR, and you're like, oh, I'm absolutely essential to this organization. So it's one of those things where maybe a little tension. Nobody wants to be non-essential unless it's a snow day, right?
I think we have one more question.
I would say any other type of compensation, unless it's the instructions give you some exclusions about what you don't need to report as non-taxable comp, maybe some benefits that are excluded under 132 as fringe benefits may not have to go, don't have to go in that column, and they're specific about what's excluded. But you know, there's some non-taxable benefits that, for example, and I'll use higher ed, where one of the great benefits is free college. That's not taxable under the code. 117D. I just have to throw it every once in a while. I have to throw out a code section just it feeds the nerd side of me, right? But you know, unless it's specifically excluded in the instructions, the value of that would have to go in there. It's not the W-2 because it's not taxable, and if it's not specifically excluded as reportable, and there's 132 covers a lot of working condition fringes and some other things, de minimis fringe benefits and those things, and then I believe most of the things under 132 may be excluded, but there are some benefits under the code that are non-taxable, but they would want you to report them.
And that's in column F?
Yeah, like working condition fringe, I think is excluded. You go to a conference, your work pays for it. Well, that's not in your income, and they don't want the value of that in that column. Yes, ma'am. A gross up payment. It's something very, if you can get one of those, it's great, because they say, we're going to give you a taxable benefit, and we're going to pay the tax on the tax. So basically, to fill that out, if you really want to get nerdy, you take, you can figure out the gross up by putting the tax rate over, I think, or it's 1 minus the tax rate, so you come up with a benefit of, let's say it was 30% taxable, you'd end up at 1.432% or something like that.
When reporting officers to CPAs, etc., is it as a specific date for everyone who's done one during?
Oh, excellent question. The compensation is as of the calendar year W-2 1099. That, and if you're giving employees 1099s, that's a whole other seminar. We've got to worry about that, because the IRS, that's one thing they always look at when they come to the exam. So the calendar year is, or the compensation is of the calendar year that ends within your fiscal year or consistent with the end of the year. Now, if you report here, anybody that was an officer during the year that had that title. When you go to Part 6, it says how many independent voting members did you have? It's as of the end of your year, not anybody that served. So sometimes there'll be a consistent where people roll off the board mid-year, which drives me crazy on the 990 side. Could you just put your board members in, consistent with your fiscal year? It makes it much easier on them. You report anybody that was an officer during that year. Officer, director, trustee, that kind of thing. If they were an officer during, let's say somebody left mid-year, all right, officer didn't receive any compensation. They would be considered, you would list them here as an officer because they had that title during the year. But they're not former if they served during that year. Former would be, they weren't an officer during the year, but they met the income threshold for having to be reported. So that prevents people from saying, okay, I'm going to give you a bunch of money, but I'm going to wait till you roll off as an officer, as a board member, and then we won't have to report it. The idea is the income thresholds are there to prevent you from being able to do that, so that for a period of, former is typically the 5 years. So you list any former officers, key employees, and highly comp who receive more than $100,000 of reportable comp from that organization. So they roll off and you give them a severance payment the next year. If it exceeds the threshold, you would report it. For an officer, it's more than $10,000 of reportable comp. So the question is just in general about how much of the information on the 990 is disclosed to the general public, or is it just disclosed to the IRS? The only difference between the public disclosure copy and the 990 that you file is Schedule B, the names but not the amounts, the names and addresses are redacted. So the IRS is very careful about saying make sure you don't disclose any personal information. Whenever we have an address for an officer or if anything needs to be disclosed, we always put care of the organization because people don't, it's very easy to find out where somebody lives and information about them if you have that. Certainly no Social Security number. There are 990s out there that probably have my Social Security number because that's what you put on it. I kid you not when you sign them, so I'm a little worried about that. Don't go looking for them.
Yeah.
All of the donors, you can put them terrible things.
No, no, the donors' names and addresses, that's the part that only the IRS gets, the names and addresses. So you need to disclose that. Right. When we give you, for our clients, when we give a public disclosure copy, it's identical for the most, in almost every case. Some of the attachments, like if you have foreign bank accounts, other things, there's foreign filings if you have alternative investments and have to do that, that doesn't go with it. And the IRS is specific about that, but the donors' names and addresses are the only thing that are redacted. The amounts. Now, there is an exception, and we see this occasionally, where, description of donated property. You can redact that if it would identify the donor. Now, getting to that, I'm jumping ahead a little bit to Schedule L, transactions with interested persons, which now includes substantial contributors. And we've gone back and forth, and I was involved in writing that letter as well, about saying, wait a minute. We don't disclose their name and address and pertinent information on Schedule B except to you, but on Schedule L, you're talking about a transaction with a substantial donor, and doesn't that undercut the protecting the identity of the donor? And the IRS has said, well, you can, what we do is just say transaction, we describe the transaction and substantial donor, but we don't disclose personal information, which I think is.
I did one more clarification. So someone said, the attorney often tell us that the number of people listed have to match the number of voting members, and she wants to verify that you make
Yes. Okay. The question is, so we're talking about the officers, let's say the board members, the voting members of the board. And remember, to be a board member, technically you need to be voting. So some people are, emeritus and may not have a vote. Technically, they shouldn't be listed because they don't have a vote. So the voting, the Part 7 is your officers, your directors and trustees that served at any time during the year. Everyone should be listed that served at any point during the year. When you go to Part 6, that asks the number of voting members and the number of independent voting members, that's as of your year end. So there is a distinction there. The number here doesn't necessarily match the number on Part 6.
All right. So compensation?
Well, I think
any final thoughts?
I know that we covered, let's see if there's any other questions. Oh, one of the questions I didn't mention on Schedule J was question 7, did the organization provide any non-fixed payments not described in lines 5 or 6? So typically that's a bonus, that's a discretionary bonus. You can answer yes, and they'll ask for a disclosure, and we say, so-and-so received a bonus of X number of dollars, or so-and-so received a bonus that is reported on Part 2 of Schedule J in column 2B, or B2 rather. Well, the interesting thing about the bonus, if it's included in Box 1 or Box 5 of the W-2 is taxable, which it should, unless, it was accrued and paid later. So you say there's a bonus, it's included in column D, reportable comp. What column B on Part 2 of Schedule J does is break out that number into base, bonus, and other. So it wouldn't be double counted. Let's say somebody made $150,000 and got a $20,000 bonus. On Part 7, we'd have $170,000 because it's included in taxable comp. On Schedule J, we break it out between $150,000 and $20,000 is the bonus. So it just slices it a little bit in more detail, so there would be no double reporting. But one thing on Schedule J, you'll notice this column, which, well, I notice it because this is my life, 990s is my life. But all the way over, column F, compensation in column B, reported as deferred on a prior 990. So we talked about, there was a question earlier about a severance payment, which we may report as compensation, other compensation, not taxable compensation, because the rules say we need to pick it up, even if I use my 457B example, where we promise you $500,000 at the end of year 5, but you may not get it unless you stay to year 5. So we're reporting that every year. Now, what happens in year 5 when it's paid out? Well, reportable comp jumps by $100,000. Column F tells us, by the way, we already reported this in a previous 990, so it's not more. So we're not adding those two together. That was something that was previously reported. How often somebody would actually read that column, I don't know, but it's important when you have those situations that you disclose it, because you can say to whoever's asking you, oh, by the way, we've already reported it, and this tells you why. Yes, sir. Correct. It would be, this is taxable comp, and this is what we, in 500,000 of it was reported in previous years. Yep. Mm-hmm. And typically when you see those arrangements, whether it's fundraisers or some other folks that have money, their compensation, they get a base and then it's pegged on performance. Anything, I would think that pay or accrue compensation contingent, question 5, by the way, is contingent on the revenues of the organization. I think if you say, okay, if you raise X amount of dollars, you get a bonus of this, I think that would be contingent on the revenues, and I would explain it. And we do have some organizations, and those in certain circumstances are appropriate. The IRS doesn't always like it, but in certain circumstances it's kind of accepted. In fundraising is the big one. You look at colleges and universities and what their investment folks make based on the income, and their fundraising, the development people make based on how much money they bring in. That's typically part, and so you'll have, if the part is based on that, the metrics, I'd say that's 5. If it's based on some other things, where if we think you're doing a really good job, we have the discretion to give you a bonus between 0 and 100, and they give you something, I would put that in Part 7. Okay. Or you could, I would separate those. I would explain both. Well, yeah, and you could put the explanations for part, say, explanation for question 5 and 7. This is the arrangement, and so this much was for metrics. But we don't have a discretion. They are contractually entitled to that money. It's non-fixed. It's not a. They're contractually entitled to that. We're not deciding it. Their agreement says they get $100,000 if they do X, Y, and Z. Versus, and then we had some discretion because they did a fantastic job. We gave them another $20,000. That would be 7, in my opinion. I would say it's discretionary if the answer is you're eligible for a bonus. If you raise this much money, you qualify for the bonus pool. And what you get is 0 to 100. You could get 0. I'd say that's discretionary. And again, there's always room in those complicated areas to explain it more on Schedule J and I think it's Part 5 or Part 4, the last section. So This is, you know, the 990 used to be check the boxes and move on, and this is be careful how somebody can perceive the information you put out there. We have some organizations that they have related organizations, and or they're not related, but the executives split time between C3 and C4, and the answer is some reporters out there adding those numbers together because we are very clear about this is what they get, and this is how much this pays, and this is how much that pays, and they're adding the two 990s together as opposed to saying we're reporting it twice so that we're in full disclosure. So,
yeah, really important topic.
Yeah, compensation could be a big one.
Let's do our second word for CPE is compliance.
The thing we always want to be in.
Yeah. So we have about 40 minutes. So
At all?
I know.
I'm just getting warmed up here. No, thank you for the questions on schedule. You know, for some organizations, compensation is really tricky, either because the number of folks you have that are over that threshold, and it's important. So I appreciate the feedback because for some smaller organizations, it's not a big deal, or some organizations that aren't really high profile. For some sensitive organizations that are either politically or socially sensitive, they get a ton of pushback, and there's a blogger out there that's going to blast them rightly or wrongly. So I think this has been a good discussion. If you have more, we can certainly circle back to that later.
So the last several parts of the basic form, so parts 8 through 11, start getting into some of the numbers, the revenue, functional expenses, balance sheet, net assets, and the financial statements and reporting. So with this, and you know, maybe we could touch on it a little, but I know we want to get into some of the other hot topics as well, and we'll get into Schedule D on reconciling the information back to the financial statements. But here, you know, when we're looking at the statement of revenues, the statement of functional, and I'll let Dick talk more about this, but there are certain reconciling items, you know, what you might see is expenses on what we're reporting in our accounting system, maybe netted against revenues here, or certain reconciling items. And ultimately, the functional expense, which we've had some seminars on, you know, is a big driver in the watchdog organizations. That's where they're pulling that information from to get your overhead allocation percentage. And so I'll let you run with this one.
Yeah, a couple things about the revenue and expense. We're starting with the financial statement, and the 990 makes you detail out certain things. You know, contributions, we break out as government, what came from, you know, like combined federal and other fund drives like that, and how much came from everybody else. So you see that, and then, you know, our investment income broken out a little bit. A lot of questions, and this is probably one of my pet peeves, is the fundraising, the special, what used to be called special events, but think of your annual dinner, gala, you know, golf tournaments, those kind of things. Everything always shows a negative there, right? The way it works is you say, okay, we brought in this much money, and this much we told them was contribution. So we take that out, and it goes on a separate line and is reported up in, that's one of the other categories that you put your detail out, your contributions. And then you're left with your other revenue, right? So somebody pays $150 for a ticket, and they get a meal worth $50. So 100,000 is contribution, and you should be telling them this. You have to break that out as a quid pro quo over $75. That's part of your substantiation requirement. So the $100 goes in contribution. We're left with $50. And then what are the other costs of the event? And the other costs were $70. So we're showing them $20 loss. People go, oh my God, we lost money on a special event. That's crazy. How can we do that? Well, a couple of things. In those expenses should only be the direct expenses generating that revenue, and not like people's overhead time for planning it and those kind of things. A lot of times organizations don't necessarily take those costs out because for their own internal purposes, it may be important for them to capture those costs. So that's a little bit different, that I think the compliance is maybe a little bit lax there, which is okay, but you just need to understand it. And then the other thing is, well, geez, are we overstating how much should be the contribution piece? Because when you say contribution, you paid 150, the value of what you get is 50, your contribution is 100. Notice I said the value, not the cost of providing it to you. Because you could have a gala where the music and the ballroom are all donated, and you say, well, geez, then the value is the cost is low. Cost may be low, but the value is still the same. Cost sometimes, if you're paying for everything out of pocket, is probably a good judge of what it is. And you're required to make a good faith estimate of that value. So a lot of times you'll see folks, when you're explaining it to the board, they go, wait a minute, how can we lose money on our gala? We got sponsorship, we raised all that money. That's up in contributions, not on line 8 in the revenue. So that's one of the things I often get questions on. And personally, I don't like the presentation, and it's detailed out on Schedule G, which we have. So that's one of the things on the revenue side. On the expense side, as Jen already mentioned, we break out program, management, general, and fundraising, and that's really important. Also, like the balance sheet and like the revenue statement in more detail, one of the things that's important to know is Schedule D takes you from the financial statement, revenue, and expense to the 990. And that's really important for the board members to know. Because I get questions, well, wait a minute, how come this doesn't match this? Well, okay, go to Schedule B. This is what we start. These are the reconciling items. What are some of the common reconciling items? This is the audience participation portion of the donated services is a very big one. Donated services, right? Revenue and expense for financial statement purposes, not 990 purposes. What's the other big one? Investments, unrealized gains and losses. Revenue for 990 or for financial statement purposes, we take it out for 990 purposes. Because we think, a lot of organizations with big portfolios, those swings could make their revenue jump up and down and skew a little bit of the support test. Yes, ma'am. That's a career-limiting move, but okay. A healthy discussion. We had a healthy discussion with my boss.
We had this conversation, and because
you're bringing up a great point, which if this isn't your question,
yes. So
you raised a great point.
Like it doesn't spend 24 hours just for the benefit telling.
Yep.
So when we sold the money and took it to an accounting system, I was like, we put the value of the stock.
Yep.
And you have to also put the loss if like
and if you sell it, yes.
Yes. And actually money is what we have, and I think we have also the loss of selling the stock and what the bank has been charging. Just like the loss. That's the figure that we have.
So I'll talk on the accounting
right.
side of that, and then I'll hand it over to Dick for the tax side of that. So, it goes back to your policies and procedures. Right now, you're describing two different ideals of how we're going to record our gains and losses, or capture our donated stock when we get it. So your organization could decide that, it is our policy to only record, wait till we sell the value of what we get, and that is our value. That is our contribution. On the other hand, maybe someone has pledged to you $1 million. I'm going to, give you $1 million. You don't know if it's coming in the form of a check, stock, whatever. Maybe you do.
That's the reporting part that I'm going
Exactly. You record your $1 million pledge, right? A pledge receivable and $1 million in your revenue. And then when you receive the items and sell them, it's $800,000. Stock market's down and it crashed, whatever the case, and then you're recording and offsetting $200,000 loss. So from the accounting side, I would just say that, if you're receiving larger stock donations in your organization, you really do want to capture those two separate transactions separately. if it's smaller and, you know, you're not receiving in this one-time thing, you know, the swings might not be variable and significant enough or material enough that is really a relevant piece of information for your organization. So I would just say to that you definitely want to consider what you're going to put as your accounting policies and procedures, and use that as the driver for how it's going to be captured in the accounting record. Now on the tax side,
going back all the way back to Part 4 seems like hours ago, right? Part 4, question 29. Did the organization receive more than $25,000 in non-cash contributions? And again, one of the common mistakes is people will put, they'll give us information as it relates to donated services. And remember, that's not in that $25,000 threshold. But let's say you receive stock of $25,000 or more. Schedule M needs to be complete. And so you detail it out, and let's say it was one stock donation, you just say public stock, and we receive that and we report it. And a lot of times we'll pick up on that by looking at the cash flow statement. See, my staff is really good. They're good accountants, they're good tax people, and they go, well, wait a minute. I said, how'd you know they got donated stock? I looked at the cash flow statement, and it's separated out there. Now, here's a tricky situation, and I'm going to jump to the conclusion, is there is no clear answer on this. So, especially people online, don't press me on this. You know, there's no clear answer. We have asked the IRS, and they're like, use your best judgment. And let's say it's $1 million of stock, $1 million pledge.
Yeah, $1 million. $1
million pledge, and so we record it in revenue this year. Well, typically we assume that pledges are going to be paid in cash, right? Somebody writes you a big check. Well, they say, hey, it's a good tax planning thing. They went to their tax person. Their tax person said, hey, give them this appreciated stock worth $1 million. You don't have to pay capital gains on it, and they get the same value. Except you got fees that come out of that when you sell it. Great. Well, now I look on the cash flow statement, and there's $1 million of stock. But the revenue was reported last year. So I look at question 29, and I go, did the organization receive more than $25,000 in non-cash contributions? If we're talking about plain English, and I hate to interject plain English and logic into patents, but just for this moment, indulge me. Did we receive more than $1 million of non-cash? Yes. Right? Okay. So where else does that show up? On Part 8, line 1H. I'm going to guess line 1H. Let's see if I'm right. And it will be a sad commentary on my life. Oh, it's 1G. Whew. Sad commentary on my life if I knew that. What's our non-cash contributions that are included in above? None. We have the answer is none because we've already recognized that revenue. That's not in current year revenue. So I've got 0 on 1G. I'm answering this question yes, which means I have to put it on Schedule M. So we said to the IRS, what do you do in that case? And they're like, use your best judgment. Personally, I think I would be more comfortable with a mismatch of line 1G and an explanation on line M. By the way, this was stock received in satisfaction of the pledge that was already recognized. And for full disclosure, we're putting it on Schedule M. But there is no answer to that question. And we can't anticipate this, unless they tell us, I'm going to give you $1 million of stock on January 1. There's no way we would be able to know that and know how to report that.
Great question.
Okay. we were talking
about the reconciliation. Oh, yeah. So we went over the in-kind donations, the unrealized gains and losses.
Investment expenses are sometimes netted against investment income on the financials?
Yeah, as opposed to expense where it would be reported as expense on the financial statements. So again, it just comes from like items.
Also with the fundraising expenses, sometimes they're shown netted against revenue.
Yep.
And sometimes they're shown on the functional. And if they're shown on the functional, that's because we have to net them revenue in Part 8. That would be a reconciling item. So there's a lot of little things that can throw somebody off.
Rental
income. I knew somebody was going to bring that up. Rental income. Sometimes clients will just say, look, it's rental income on Part 8, and I'm supposed to show the expenses on Part 8, but I show the expenses and the functional.
Yep.
That would be a reconciling item. Sometimes clients will say, we'll show it gross there and we'll show the expenses.
If it's significant, you know, there
yes,
might be different than if it's not. Well, it just depends on the size of the organization. Jacquet is asking us what is the percentage of what we would consider significant.
Yeah, technically, you should show those expenses there, but sometimes the cost of trying to go through after them, when it's just like a sublease or whatever, clients will say, like, I can't really, it's not worth it to get that. Technically, the answer is you should report them there.
Yes. So the IRS doesn't, you know, they would say
there's no materiality.
Exactly. But when you ask an auditor, we like materiality. So, all right, great. Let's talk a little bit about the public support test. So
as
definitely,
I mentioned before, there is no succinct way to do this, but by a show of hands, including you online, if you're sitting there at your desk,
raise your
if you're a 501c3 organization that has to do the public support test, raise your hand. Okay.
So we have a couple, yeah.
You know, again, quick lesson in exempt organization tax. If you're qualified under 501c3, you are either a public charity or a private foundation. The presumption is you are a private foundation unless you can meet one of the tests for a public charity. Some organizations are by nature, by the definition, are public charities, schools, hospitals, churches, those kind of things. Organizations with some relationship to them, medical research organizations are there. Most other organizations need to pass the public support test. Another ones you'll hear, supporting organizations don't have to pass the public support test because they support a publicly supported entity, which can also be a C6, but that's a whole other seminar. So, basically what the test is designed to do is to say, I have enough support from a broad base of people that I am a public charity versus a private foundation. Private foundation, where's the Bill and Melinda Gates Foundation get their money? Bill and Melinda Gates. With Warren Buffett giving, so he gave a lot of his money in there too. So they get a bunch of money from a few people. They would not be able to pass the public support test. Because the way it works is, it's a 5-year test. And so you look at all your support over that 5-year period, and there's a 2% threshold. So you take, let's say your support's $100 million. Wouldn't that be nice, right? $100 million over 5 years, that's a good, healthy number. 2% of that, I just did it because the math is easy. It's Friday, I was told there'd be no math today, right? $2 million. Everybody that gives you money below that threshold, it counts in our numerator to determine what our percentage is. And the key is 33 1/3. So if everybody gave me under $2 million, I'd in essence be almost 100% supported. With all my money, all my contributions would go into the numerator. Now what goes in the denominator is your contributions, your investment income, and some of your other revenue. So technically it's hard to reach 100% if you've got investment income, because that drives it down a little bit. So a lot of our organizations, well, I'll get to government in a second. So that's how it works. So let's say your threshold is 100, your support for that 5-year period is $100 million, and somebody gave you $90 million. Great if you want to be a private foundation, not so good if you want to be a public charity. So what would happen is the first $2 million would go in the numerator, and that other $88 million would go in the denominator, but not count as good support. So that's an extreme example of how that's calculated. Now, some exceptions that are very important. We have that's a good point. Let's go. Make sure I come back to that. Excellent question. So we get that money and we say, okay, we want to meet the 1/3 public support test. So when we talk about, you know, we were talking about the 5-year test. So, the exceptions. Before we get to let's say the $90 million, instead of being given to you by a private foundation or an individual or a corporation, was given to you by another publicly supported organization that meets this test. All good money. the theory, at least in my mind, is they raised it from the public, and that retains its character to you. What about government money? Also not subject to the 2% limit, because the government money comes from all of us, right? Well, except if you have a $1 billion loss carry forward like that. That was a tax statement, not a political statement. So the government money comes from all of us, right? So government money and other public charity money is not subject to this 2% limit. So we have organizations that are primarily funded by USAID, government money. All that money is good money, even if it came from one payor. If you got $100 million from USAID, you're a public charity, and you're probably 100% publicly supported because you can't really invest your money. You don't have to. You're spending government. You're spending it on your mission. So, what happened if I'm a 509A1 public charity? Also slash /176. Just had to get that in there. That's a contribution-based charity, and as long as you have enough amount of contributions, even if you generate program service revenue, money from conducting educational seminars, a museum, from admissions, that kind of stuff. As long as you have enough enough contributions, you can be a 501. Okay. 509A2 is more of a revenue-based thing. Hospitals, they get a lot of their money from treating patients. And again, they're automatically public charities, but museums that charge admission. Other things that charge fees for their services. Colleges and universities, again, for example. So you have those two tests. The 509A1 test, you want to meet 33 1/3, but you can go as low as 10%. The 509A2 test, if you go below 33 1/3 for 2 years in a row, and there's also an investment income limit on that as well, you fail. So you have to fail the test 2 years in a row to not be a public charity. This will get me to the person's question in a second. So between 33 1/3 and 10%, you're in the facts and circumstances of your 509A1. You have a statement. There's some things in the regs that tell you about how you could consider public charity, and you attach that explanation, and the IRS never looks at it because I've never had any question now. Yes, ma'am. Okay, yeah, the question is, let's say we had public support in 2011 and go to 11, 12, 13, 14, 15, because it always includes the current year and the previous 4 years. Before the form change, it was a 4-year previous test. Now it includes current and previous 4 years. So it went from a 4 to 5 year test. Let's say that the only revenue you had in those other 4 years were from one donor, and all your public support that you had dropped off. You would fail 15, but you would still be considered a public charity until you failed 16. And there's some rules in transition. At the end of 16, when you go, oops, I failed, now I have to do a 990 PF. And I am getting to that question. I forgot about it. But you're not subject to certain things that a private foundation would. During 16, they would kick in if you transition in the beginning of 17. So there are some transition rules that you would have to worry about. So the bad thing is, when do you realize that you failed the 2016 test? 2017. So so we work with our clients to monitor those situations and make sure they understand where they're at and what they need to do to pass. Now, let's say you don't pass. What are the rules that apply? Why would I not want to be a private foundation? Private foundations have another layer of rules because they're in essence closely held, they're controlled, and can be controlled by a few people, particularly a large donor. Self-dealing. You know, we can have a transaction with a board member. Self-dealing rules in the private foundation say you can't do that. Distribution requirements. We have to distribute a certain amount of our income, 5% of the value of our assets each year, because we want to make sure that that money that I gave in year 1 doesn't sit there and never get into what they call the charitable stream. So they have to give every year. Gates Foundation has to give billions of dollars a year, probably. You're sitting on $100 billion, you got to give $5 billion a year. That's hard work. Believe it or not, giving away that much money because you want to make sure it's used right. Okay? Jeopardizing investments. You can't invest in risky things. Taxable expenditure. If I'm a charity, I can give money to a for-profit corporation as long as it's for good C3 purposes. If I'm a foundation, I give money to another foundation or give money to an individual. I may have to exercise what they call expenditure responsibility, or I'm subject to an excise tax. I had this issue come up yesterday. There was an organization that started out as a private foundation. You can transition to a public charity if you're publicly supported. They said to the IRS, we're starting our 60-month transition period. And then at the end of 60 months, where you're supposed to notify the IRS that you satisfied the test, oops, forgot. So there's still a private foundation. Well, my manager comes to me and goes, you got a second? I always hate when they say that, right? Because I know this is going to be more than a second, and it's going to be an issue because they're really smart. It's going to be an issue that they've identified that they're going, uh-oh, I got to talk to Dick or Steve about this. Steve's my colleague. We work in the department. We run the department. So this organization is fully funded by the federal government, but never did the paperwork, gave a loan to their executive director. If you're a 501c3 public charity, that's okay. It needs to be disclosed in Schedule F. And you should have, the board should approve it, it should be in writing, and there should be an interest rate, and there should be all these things that you should do so that you don't disadvantage the charity and use their money for personal purposes. Strictly prohibited. And there's an excise tax. And I go, well, great. Sometimes they just made a mistake. They thought they were a public charity. Okay. Oh, this tax cannot, the first tier penalty, usually you have a reasonable cause, you correct it within a period of time, can be abated. Nope, not this one. Specifically says can't 4940 can't be abated. Oops. Yeah. So that's one of the reasons you don't want to be a private foundation if you can help it. You have to be sensitive to all these rules that apply. So
great. So I'm going to give our last word. It's support. We only have about 10 minutes left. So I want to let's hit on lobbying for a second.
Okay, big picture. And that's Schedule C if you do lobbying or if you've made the election under 501H. So 501c3 organizations can lobby, but they just can't do too much of it. How much is too much? Nobody knows exactly. So you guys are right with me on that. Now, because of that, the IRS said you can agree. The IRS and your organization can agree by filing an election under 501H that says we will be governed by an expenditure tax. Because lobbying can be volunteers. It can be a lot of different things that you can be doing too much lobbying, not just how much you spend. It could be, lots of different ways. So they said, okay, by filing this election, you agree to a sliding scale based on your overall exempt expenditures that this is how much you can spend on lobbying. And if you exceed that level, and there's two tiers, grassroots and direct. You have an overall lobbying limit. And within that overall lobbying limit, 25% of that you can't exceed for grassroots. So if you exceed this limit in a particular year, you can be subject to an excise tax for doing too much lobbying. If you, on a 4-year test, you exceed the limit by 150%, you've just lost your exempt status. Now, the interesting thing about that is you can unelect. So if you're getting toward that, you may unelect. Who would not want to elect? Because once you get over $17 million in revenue, or in expenditures, I'm sorry, you're capped at $1 million. Well, $1 million is a lot of lobbying. But if you're a C3 with $500 million in revenue, that's a very small percentage of your overall budget. And you'd be still capped at $1 million. So larger organizations may not elect because once you're over 17 million in expenditures, you're capped at $1 million. So that's the thing. And so you capture your limits on both the annual basis and on the 4-year basis. And most of our clients don't really come near it. And if they do, they know what their limits are. They know what their budget is for expenditures. They're very sensitive when we work with them. if you don't elect, you have to disclose your lobbying activities, and you're technically, you can't use this as a backup saying, well, but I would have been within this percentage. The IRS says, but you didn't elect, so you can't do that. So that's the important thing. Political activities, you know, C4s can be political, C6s can be political, but they may pay a tax on it, and it's the higher of their, or it's the lower of their invested income or their political activities. That would also be disclosed on Schedule C. C3s cannot do any political, so even though some probably do.
Yep.
We talked about Schedule D and the important
Yep.
parts about that. You know, other things that you disclose on Schedule D just briefly is if you have an endowment, permanently,
Yep.
You'll give details on that from year to year. If you get contributions of art or historic treasures, there's some disclosure on that. There's a few other things, but those are some of the interesting things. We talked about fundraising.
Yep.
One of the important things on fundraising is if you use a professional fundraiser and you have to disclose it on Part 1 of Schedule G, the states where you're registered, you know, we say, oh yeah, we do this great solicitation. States, none. Well, that's a problem.
Yeah.
Like I said, the Trump Foundation found out about that because if you're soliciting contributions in a state that you're doing business in and you're not registered, they'll say your activities are suspended. You can't do activities here until you get those right.
So we talked about Schedule J compensation. So let's spend the last couple minutes just talking about unrelated business income and the potential tax that goes along with that. So, you know, it is, you know, there are instances in which a tax-exempt organization are in activities that are generating income not directly related to their mission. I think, you know, we're all familiar on the next page with a couple of the exclusions, that being the certain rental incomes, investment activities to a certain limit.
You know, basically passive activities where you're not really conducting a trade or business.
Exactly.
Investment income is not related to your mission. It's just excluded under the code.
Under the code. Yep. So, you know, if you were generating unrelated business income, we would go and file a 990T, a separate document to capture that information. And so I'll let Dick speak on some of the most common unrelated business income items that we see. Advertising activities.
Advertising in periodicals, if you have a magazine. There's a number of exclusions. You know, it has to be unrelated to your mission, regularly carried on, and a trade or business. Well, a trade or business means there's profit motive. Regularly carried on means how often is regularly carried on? Nobody knows, right? So if you do an annual, or you know, you do a couple meetings a year, and you have a program that people, you know, sponsor. In addition, you know, they give you $10,000 and you give them a full-page ad. It's really an advertisement, not an acknowledgement. An acknowledgement just says basically thank you, name, logo, no comparative qualitative statements. Think of PDFs. This next segment is brought to you by the generosity of the Ford Foundation, the Carpet Foundation, whatever. Just plain to the point versus, you know, hey, best car dealer in town, go visit, you know, that kind of thing. So you have advertising, you only do it twice a year. I'd say that's not regularly carried on. 4 times a year. Now we're getting closer. So there's a big case called the NCAA in their Final Four. Then the NCAA actually won by saying it wasn't regularly carried on because the event itself was only 4 days, but they were selling advertising all year long. The IRS got that still drives them crazy. I can see why. When do they start selling advertising for next year's Final Four program? You know, the day after the Final Four, right? So that's a big exclusion if it's not regularly carried on. Volunteer activities, you know, thrift shop has 2 potential exclusions. Donated goods, you're selling goods that were donated to you, or you're selling activities that were primarily conducted by volunteers. Also, you see the little, it's Little League games, little hot dog stand or whatever, you know, probably volunteers, probably not subject to UBIT. So, but typically it's advertising the periodical that's regularly carried on. Debt financed income. You own a building, you have debt on it. You rent out 3 floors. That's typically what we see. Job boards on your website. You get money, people say, hey, I want to advertise, you know, we're a trade association of doctors. I want to advertise for medical things. Probably not related to your mission, probably not distinguishable from other commercial boards, except if you're, you know, you get into the area where, let's say we're only advertising jobs for medically underserved areas. Then it's probably close to your mission of, you know, promoting good health care for everybody, something like that. Web advertising is the other one.
So just a couple final thoughts, I guess. You know, I think we kind of covered the transparency of the information and that this is about a public document and the importance of the information that's going to our various contingencies. And I think we've actually talked a little bit about the state filing issues and making sure that we're registered to solicit contributions in those states. And then
one other issue that comes up, how many organizations have people that work from home in another state? That can draw you, that can mean that your organization is doing business in that state. Some states are different. If it's one person telecommuting, you know, and I forget which is which, you know, New Jersey says, not a problem. New York says, welcome to New York. You know, so you have to be careful about that. And mobile workforce is getting more and more. I told you my wife works at Georgetown, and there was a HR conference going on, and I stopped by to see her on my way home from work. It was up in Woodley Park in D.C., and I said, great, I'll stop and we'll get dinner in Woodley Park. And so all these HR people are talking to, hey, said to her boss, hey, so-and-so wants one of their employees to be able to, their husband got transferred to Georgia and wants to be able to work from Georgia. And her boss looked at me and says, what does that do to us from a tax perspective? I said, brilliant question. It may actually mean that a university or some other charity is doing business in Georgia and have to register as a foreign entity doing business there. Foreign meaning not organized under the laws of Georgia. And every state's different, but you need to be sensitive to that. Liability issues, risk management issues, lots of things beyond tax. For solicitation, there are about 38 to 40 states, I count them and it changes every time, that require you to register to solicit contributions. So that's to solicit in the state, and the state AG can stop you and say, sorry, can't solicit unless you're filing. And they may require you to file a copy of the 990 with an annual update, something like that. Doing business is more of a corporate law concept, and if you're doing business in a state, you may have to have a different registration and maybe even file some sort of tax return as well. Oh, excellent question. And you had to wait till the end to ask that. That's 1 minute. That's a great question.
So the question was that even if you're online, if contributions are coming in from different states.
And we work with an organization that does a lot of the solicitation filings. We have a good relationship with them because it's not something we do, and they can do it. They know all the laws, and they can do it cheaper and faster, and we recommend. There's a couple of them out there that I think do a good job. I've been told by people who work there that some states, Florida being one of them, and a couple I'm blanking on the others, if you have a donate here button on your website, you are soliciting in Florida, or you're soliciting in X state. Now the enforceability of that, you know, this stuff is still in flux because the laws never keep up with the technology, and you know how fundraising has changed over the last several years. The laws are still way behind. 20 years ago, the IRS says, "Hey, we're going to look at this internet thing." You know, it doesn't look like it's going away anytime soon. So you have to be careful about what you're doing. And certainly, if you have other activities in a state like Florida or whoever might say that, you know, that can pull you in a little bit. That can give you a closer connection. So you have to be careful about, as that law develops, what you're doing.
Marina. So contracted services from a different state. Also, the question is, do we need to register as doing business as entities on entities?
I'm going to caveat my answer by saying I think that is more of a legal question, but sometimes it has to do with the relationship that you have with the contractor and their ability and where now I'm going back to law school days many years ago. I even had hair back then. Where what they can do on your behalf may impact what the state says about your level of connection. They call it nexus. What your nexus is with that state depends on the agency. Are they your agent? Were they company contracts? Could they be considered your employee? Because typically, if you have an employee or you have space there, most states, I think, would say you have a pretty close connection. You may have to file.
Great. Well, that's all we have today. Thank you, everyone, for coming out and
for being online as well.
Yeah, and as we always mention, we're here. We've got so many great experts on the 990 side as well as the audit side. So if you guys ever have any questions, please feel free to reach out to us. We're invested in the nonprofit community. That's where we love to be. So we certainly love to help as well. We do have 2 final seminars in this series for this year. The next one being some common findings, a management letter, comments around the audit, and then January we're going to just leave it as an open forum. Bring questions that you think that you have, and in any respect, obviously accounting related, but we'll keep it very open.
Maybe even tax related.
Maybe even tax related. I'll have to bring you back. So.
now I know where the hotel is.
So thank you all for being here, and we look forward to seeing you next time. Yeah, survey and sign-in sheet so you get your CPE.
Yeah, we take the survey seriously, and but if we get some bad feedback, we may just have to get an anonymous email to your boss that says, "This is only a 2-hour seminar. It's not an all-day." Just kidding, just kidding. We do value the feedback.
Great.
Well, welcome. No, it's
Sure.